right, so that brings us to the third activity. The third activity is kind of a catch-all, really, to finish, to get close to finishing up our Chapter 10 types of assets, to hold off for that self-constructed asset, which is the one that comes after this set of activities. But these are the assets acquired without cash. So each of these is independent, and I ask you to identify the asset and then identify which fair value is more clearly evident in the given situation, because that is what GAP says you use. This is the rule. Which fair value is more clearly evident? That's what you use to decide how to value the asset. So this one essentially just comes down to these three situations and what would the journal entry be. So if we look at this first situation, we purchased equipment by signing a note. We actually looked at this the first day of class when we were looking at Chapter 6, kind of the warm-up activity, if you will, the first activity we did, where you had to take the present value of the non-interest-bearing note at the given rate for the number of periods. So in this situation, I tell you there's no known market value for the equipment, so immediately you say, well, I guess the fair value of the note is more clearly evident. And then you look and you go, oh, I guess it is, because I know the rate. I know what has to be paid out 2 years from now. I can take the present value, and that gives you the fair value of the note today. The present value and the fair value are going to be the same. All right, so to get to the value, then here we need to take the present value. It's the present value of a lump sum of n equals 2. Pay attention to the dates. Okay, it's January beginning and December ending in 2017, so that's an n of 2. Common mistake to think that's 1 because you just say 17 minus 16, but it's 2 full years. Of the 50,000. And when you do that, you essentially get, 44,500. So that is the more clearly evident value. That is the value we're going to use for the equipment. Oops. On the next page, I'm going to put the entry. I don't really have room to put it here. All right, but there's where we'd go with the value for the activity, this A, that equipment. Now, if we look at B, and B, we issued 1,000 shares of our stock for some equipment owned by BBFF. Now, we know the value of our stock. It sells on the stock exchange for $30 a share. The equipment was purchased in 2008 for $75,000, and there's no active resale market. So which of those two has a more clearly evident fair value? That would be the common stock, because essentially I told you there's no available fair value for the equipment. We have the value of it 8 years ago, but that's not likely to be its current fair value. So we're going to use the value of the stock in this situation. And the value of the stock that was issued in exchange for the equipment would be 1,000 shares, times $30. And so we would have 30,000 as the value for the equipment. Okay, so in this situation, 30,000 is the value for that equipment, right? So that one's pretty straightforward as well, isn't it? So that brings us to C. In C, I basically just say Amazon donated 200 Echoes, and the fair values of the Echoes was 10,000. So here I told you the fair value. So that's really easy on my part, but really, because the point with this one is to recognize what do you do with the other side of that entry. Okay, so here 10,000 is just kind of given. It's the the value of those echoes is given to us. When we look at the entry, the key here is when someone donates an asset, the other side of the entry is going to be a revenue. So when we get to the next page, we will look at the entries. I believe. All right. So I'm going to put entries on here. I'm going to put them up here so you can see them. This one was the non-interest bearing note. We're going to debit the equipment. We're going to debit discount on notes payable. Whoops. For and we're going to credit notes payable for 50. Now let me fix that and line the debits and credits up a little bit better. Hopefully. Just to make it look like a journal entry. There we go. That looks better. All right, so that is A. In B, we had the I can't find my spot. There we are. We had the equipment in exchange for the stock. So for B, we had a debit to the equipment for $30,000, and we had a credit to common stock for $30,000. So there's that one, right? And then finally, for C, we had the donated echoes that we valued. Where did you go? Sorry, I don't know what happened right there. Trying to get back right here. There we go. Ooh, 10,000. And the other side of that one is going to be a credit to revenue. You'd probably call it donated asset revenue or some weird miscellaneous revenue. Doesn't happen every day, right? You don't run your business hoping people just give you assets. But there you go. There's the entries for that activity 3. We're all good. So that is the end of those activities. So that should be the end.